Hi, my name is Susana Jorge and I'm Professor of Public Sector Accounting at the Faculty of Economics of the University of Coimbra in Portugal. Welcome to this lecture about conceptual frameworks in public sector accounting. In this lecture, we will address particularly the IPSAS conceptual framework, but while taking this as a main reference or benchmark, we will also present views on selected national frameworks of several European countries, namely Germany, Portugal, Austria, the UK, and Finland. This is particularly important to understand that while some jurisdictions follow and adopt and approximate the IPSAS conceptual framework, other jurisdictions in fact diverge from this framework. Accordingly, this lecture starts by discussing the role and authority of a conceptual framework comparatively to the standards. After it presents the main topics addressed in the IPSAS conceptual framework, and finally, it presents the comparative international analysis of different national conceptual frameworks, taking the IPSAS conceptual framework as benchmark. The topics addressed in this lecture are these, and they are going to be addressed. They are going to be divided in three parts. Part A, comprising topics 1 to 4, will address particularly the objectives, the users, the main accounting principles and qualitative characteristics of financial information included in the general purpose financial reporting. Part B will address the recognition of the elements within the financial statements, the definition of those elements, the recognition criteria, and the measurement criteria, always taking the IPSAS conceptual framework as reference. Part C will finally briefly present the comparative international analysis and will also offer some self-assessment questions and bibliographic reference to support the study and the understanding of these matters. At the end of these lectures, students should be able to understand the role of a conceptual framework compared to the standards, should be able to indicate the main objectives, users, and qualitative characteristics of the financial information, and also should be able to apprehend the main elements, the definitions, and the recognition criteria, and also to be able to distinguish the main measurement criteria for the different elements within the financial statements. All these taking the IPSAS conceptual framework as reference, but also considering that there are other national frameworks that might be different than the IPSAS conceptual framework. Moving immediately to the role of a conceptual framework versus the accounting standards. What is a conceptual framework? Why do we need a conceptual framework in this case, in particular, in public sector accounting? In other lectures, we already discussed the specificities that the context of a public sector requires to the interpretation of the concepts. But still, why do we need a conceptual framework when we have the standards? A conceptual framework, it's not a standard, of course, but it's very important to help the application of the standards. In fact, it's a basic theoretical structure that underlies the standards. It addresses the main elements of the financial statements and establishes the main concepts that in fact underpin accrual-based general purpose financial reporting. Please be aware that once we are addressing particularly the IPSAS conceptual framework, we are talking about accrual-based accounting. The conceptual framework addresses the main users, objectives, qualitative characteristics, and the concepts. And the concepts relate to the elements within the financial statements. And these elements are assets, liabilities, revenue and expense, net financial position, and ownership contributions and distributions. The conceptual framework not only defines these concepts, but also establishes recognition and measurement criteria to be considered in the standards. But these recognition and measurement criteria are overall, are general recognition and measurement criteria. They are not specific for a particular type of transaction, for example. That is to be done in the standard. Each standard offers particularly binding guidance to recognize, measure, present, and disclose a specific transaction in a financial statement or in the financial statements. But this is not the case of the conceptual framework. The conceptual framework is a general structure that underlies all standards. So it defines general criteria for recognition, several criteria for measurement, and not a criteria in particular. Of course, if the standards are also developed on the basis of the conceptual framework, there has to be a coherence between the criteria adopted in the standard and those allowed or established in the conceptual framework. But there should be this coherence, but in rare cases where there might be a conflict, the requirements in the standard prevail. Referring to conceptual frameworks in general, the literature highlights that historically they have appeared after the standards. The standards might have derived from accounting practice, and there was a moment where there was a need to give some theoretical coherence and perhaps even to legitimize the standards. And this is also the role of a conceptual framework. For example, let me give you an example in my own country. We recently passed an IPSAS-based public sector accounting standard. We have now a regime that is IPSAS-based, a system of accounting standards that is IPSAS-based for public sector. But we also have budgetary reporting, and because the IPSAS do not address budgetary reporting, we adopted the IPSAS conceptual framework, but there was a need to create a conceptual framework for budgetary reporting because the concepts are actually different. And in order to give coherence to the application of the budgetary reporting rules, we had to establish the concepts. So, what is the importance of having a conceptual framework? I should say that it is important in four perspectives. It is important to support preparers of financial information, auditors, users, and standard setters. First of all, preparers. To have coherent concepts on the basis of which the standards are applied is very important for those that actually use the standards to prepare the financial statements. So the conceptual framework is important to support the application of the standards. In this case, we are talking about IPSAS standards, but for example, in EPSAS standards, when they come to happen, there is going to be also a conceptual framework. In second place, the conceptual framework is also important from an auditor's perspective. For example, if an auditor has to form an opinion whether the financial statements are prepared in true and fair view in compliance with the standards, so it is important to know the conceptual framework, the concepts and principles underlying the standards. Thirdly, it is also very important for users because it helps users in the interpretation of the information within the financial statements. And finally, but not less important, it is very important to help standard setters when they are defining new standards to be coherent with the theoretical basis. So the conceptual framework is also very important to offer the basic concepts to the standard setters when developing a new standard. Before we enter the elements of the IPSAS V conceptual framework, I would like to introduce you to some conceptual frameworks that actually exist worldwide in specific countries, although the IPSAS V is the international one. In United States, we have the FASAB, the Federal Accounting Standards Advisory Board, and they have a handbook of federal accounting standards and other pronouncements. This is for federal level. At state and local level, there are the pronouncements of the Government Accounting Standards Board. In Europe, there are also several conceptual frameworks. For example, the UK for central government has a conceptual framework within the Financial Reporting Manual, and this conceptual framework is IFRS based, although it is for the public sector, for governmental accounting. When we speak about continental countries, we have, I should say, two main streams. We have some countries, a group of countries that may say that they are IPSAS V adopters. They adopt IPSAS V conceptual framework. For example, Spain since 2010, Portugal since 2015, Austria since 2013, and France since 2016. Austria and France particularly at central government level. These countries basically they recently in the last 5 to 8 years they have embarked in public sector accounting reforms towards IPSAS, and then in those processes they have adopted the IPSAS V conceptual framework. On the other hand, there are countries that have stick to their own national frameworks because there is a strong national tradition that still prevails. In this trend, we have, for example, Finland and Germany that, although also have accrual accounting, Germany particularly in central or federal government is an option. In some states, accrual accounting is already used, and in local government, for example, is essentially cash budgetary cameralistic accounting. But so they do not follow IPSAS, although they might have accrual accounting. They have their own accrual accounting rooted in the business accounting rules and or derived from business accounting rules. And so they are not following the IPSAS V, but they have their own national frameworks, as we will come to see later. Entering the IPSAS V conceptual framework, the conceptual framework is organized in 8 chapters, as we will see here, and we will try to go through all of these briefly. The first chapter is on the role and authority of conceptual framework. We already discussed basically these in the previous slides. But what I would like to highlight here is that of course the conceptual framework does not prevail over the standards. As I said, if there is a conflict, standards should prevail, but neither the standards nor the conceptual framework are compulsory in every country. In the countries, in fact, the governments are sovereign and they have to adopt or adapt the IPSAS to their own legislations, so the conceptual framework and the standards become compulsory. In this slide, I would also like to highlight that the IPSAS V has had several inspirations to develop the IPSAS conceptual framework, from FASB, SAB, the FASAB, the GASB, as I already mentioned, but the most important one perhaps has been the IFRS's conceptual framework, so the IASB conceptual framework. Moving immediately to the elements, the topics addressed in this conceptual framework, the first part of the conceptual framework regards the objectives and main users of financial reporting within the public sector. And the objectives of the information that is reported in the financial statement is to provide information. So general purpose financial reporting aims at providing information to several users, a diversity of users with very diverse information needs. But these information needs have been grouped in 2 main groups: accountability purposes and decision-making purposes. And these needs, in fact, the usefulness of financial reports is determined by the needs of the users. But one thing I would like to question in this lecture is whether, in fact, the word users is correct. Are these individuals, groups, organizations, in fact, users of the general purpose financial reporting of a government or a public sector entity? Or are they instead addressees and stakeholders? In fact, the literature on the conceptual frameworks and on the objectives since the 90s within the user needs paradigm points to several users, several other addressees, and several purposes. Initially, essentially regarding accountability purposes, and more recently also decision-making purposes. But as I was saying, are they really users? For example, the IPSAS CF points as primary users, service recipients, taxpayers, and resource providers. Well, taxpayers are also resource providers, compulsory resource providers, but in fact, resource providers are seen here as the investors in the markets, donor agencies, etc. On the other hand, there are other users, they are not primary, but they are also users, like government statisticians, analysts, media, regulatory and oversight bodies, audit institutions, the parliament and government committees, groups of interest, etc. But I question, are they actually users? Perhaps most of them are just addressees because they don't make decisions. They are just they requiring accountability regarding public sector accounts. But there is here the literature since the 90s at the same time as discussing whether they are users, addressees, stakeholders. Several criticisms have been raised, and they essentially relate to the lack of verifiability, which is a problem. It's not, there is, in fact, there is no proof whether these users are in fact users of the governmental accounting information. It's not clear whether this number of substantial users in fact exists, because perhaps some of them, they are just addressees, they are not decision makers, they do not understand the complexity of general purpose financial reporting. I leave these to you for reflection. So they might be potential users, or potential addressees, but are they in fact real users? For example, one of the recent lines of research concerns analyzing whether politicians as representative of citizens, as service recipients, taxpayers, etc., are in fact users of governmental financial reporting. So, but why are these called primary users? Well, the general purpose financial reporting cannot address the users of all these institutions and individuals. So they admit that they have diverse needs, but in fact these needs might be grouped in these two purposes: accountability and decision making. And these users do not possess the authority in general, these users in general, do not possess the authority to require a certain public sector entity or even a government to produce a particular type of information or a particular report. Some users might have that power, for example, a bank, etc., to a particular entity, but that information that entity will produce is not considered general purpose financial reporting. This justifies the name general purpose. The financial reporting is addressed to satisfy general purpose needs. So general purpose financial reporting are not developed to specifically respond to particular needs. And just to highlight, as I said, that representatives of citizens are in fact politicians in the parliament, legislature, or government. Coming to the information needs, the conceptual framework of the IPSAS points to these 8 categories. And basically, they say that while categories 1 to 3 are common between service recipients, citizens as service recipients, and resource providers, categories 4 to 6 are more to service recipients, and categories 7 to 8 are more to resource providers. Well, there is a big problem. Of course, we may understand that while, for example, resource providers, investors in the markets, etc., are more preoccupied in understanding the capacity, the liquidity and solvency of the entity, and the need of the entity for future funds, and how current operations are being funded, for example, citizens as service recipients are much more concerned about the sustainability of the entity in terms of service delivery, or whether to understand if the resources that come from taxes are properly applied, efficiently and economically applied, whether the services provided, the cost of the service provided are appropriate, because perhaps they are requested to pay more taxes. This makes sense, but there is the doubts continue. Is the evidence about these needs concerning the several users that we already referred to. Now I would like to move to the main accounting principles, and although these principles have been addressed in previous lectures, I would like here to highlight a few that I consider more important to highlight in this lecture. Some of these principles are not exactly explicit in the IPSAS conceptual framework. One is the accrual regime. In fact, it is assumed that although it's not explicitly stated in the IPSAS conceptual framework, IPSAS are accrual-based accounting. So they allow to produce general purpose financial reporting under an accrual regime. This accrual regime prevails in financial accounting because IPSAS, so the IPSAS conceptual framework, addresses accrual accounting and particularly focus on financial reporting, financial accounting. And according to this principle, transactions are to be recognized when they occur, regardless the moment where they are paid or received. Therefore, the transactions and events are recorded in the accounting records and recognized in financial statements of the periods to which they relate. And these elements the elements recognized in these statements are assets, liabilities, expense and revenue, and net assets or equity or net financial position. On the other hand, opposing the accrual regime, we have the cash regime. And the cash regime, although might be used in financial accounting, and in some developing countries they still use a cash regime in financial accounting, but in most European countries and internationally, it prevails. In most European countries, I should say, a cash regime prevails in budgetary accounting. Cash accounting means that the transactions are recognized only when cash is paid or cash is received, and the statements provide information about the sources of cash, where the cash is coming from, and where the cash is applied, for what purposes the cash is used, and what is the balance at the reporting date. And the elements recognized are cash expenditure, payments, and cash revenue as receipts. But we must pay attention that, in fact, cash accounting is not a synonym of budgetary accounting. In fact, although budgetary accounting in many countries is cash-based, in several countries is already accrual-based. For example, in central government in UK, in Finland, in Germany, in some local governments in Germany, in central government in Austria. On the other hand, in the accrual regime, there is also a statement of cash information, a cash flow statement. They make part of financial statements under the accrual regime. So this has to be considered. Another important principle is the going concern principle. And the going concern principle says that the financial statements must be prepared on a going concern basis, meaning that there is no intention of a public sector entity or a government to cease operating. But sometimes there are uncertainties that raise doubts about this going concern, the ability of the entity of going concern. And whereas these uncertainties normally in the business sector, they regard concepts related to liquidity, solvency, so financial viability, in the case of the public sector context, this going concern basis has to be assessed much more in a long-term perspective and concerning sustainability and not economic sustainability or financial sustainability and not financial viability. For example, as it says in the slide, not only tests of liquidity and solvency, but taking other issues, even non-financial issues, to consider the going concern basis. For example, the power to levy taxes. In a government, while the government has the power to levy taxes, perhaps sustainability in the long term is assured, so the going concern is assured as well. So, but in a public sector entity in particular, the going concern relates much more to the ability of an entity to keep going, providing public services, more than to issues of liquidity or solvency. And sometimes this keeping public service provision relates to other issues related concerning inclusively restructuring process, etc., that one entity will absorb other entities, etc. A final principle I would like to highlight concerns the substance over legal form. And perhaps this principle is a general accepted accounting principle is in many jurisdictions. This principle says that when an economic transaction is to be recognized, in order to faithfully represent the reality, that transaction has to be recognized according to the economic substance, which should prevail over the legal form, the ownership, the legal property concept. But in some jurisdictions, and let me speak about Portugal in particular, for many years there was a principle of legality that was overriding this substance over legal form. And although the substance of legal form principle was considered in some transactions, for example, financial leases, public domain assets recognition, it was not a general accepted accounting principle because of the legality overriding. So now that we have adopted a public sector accounting system, IPSAS based, we have moved to the substance of a legal form as a general accepted accounting principle. So in jurisdictions as in Portugal, where this change came to happen, now criteria related to economic control should prevail on the recognition of the transactions in order to faithfully represent the substance of the transaction. So the economic control criteria will prevail all over the legal and ownership criteria. And this for sure will have important implications, for example, in the financial statements of the jurisdictions of the public sector entities in Portugal, in particular, following my example. And these will be important. This will have important consequences, for example, in the balance sheet, because perhaps in some entities, some assets were not recognized in their balance sheet, and they will have to become to be recognized in that entity, and derecognized in other entity due to the economic control criteria that is actually derived from the application of this principle. Coming to the last point of this first part of our lecture, I would like now to address the qualitative characteristics of the financial information and the main constraints that are presented to these qualitative characteristics. Before I explain each qualitative characteristic in particular, I would like to explain that according to the IPSAS V, the relative importance of these characteristics are the same. There is no hierarchy between these characteristics, explaining that one is more important than the other one. And these characteristics are relevance, faithful representation, understandability, timeliness, comparability, and verifiability. As you will see, related to these characteristics, main characteristics, there are others, perhaps principles, that are required for these characteristics to be accomplished. And these qualities of the information are very important to determine their usefulness. So, in order the financial information that is reported in the general purpose financial reports to be useful, either for accountability or decision making, and for several users or addressees or stakeholders, it is important that the information reaches or has these characteristics. The first one is relevance. What can we say about relevance? A certain information is relevant when it makes a difference in the financial statements for those that are looking at the financial statements to make decisions, for example. And this information related to the relevance is the idea of materiality. And to assess whether a certain information is material or not, it's a matter of judgment, and it's not easy. It's a relative concept. But in fact, materiality sets the quantitative threshold for relevance. For example, a certain item that has a very, very minor value within a balance sheet, if that item comes not to be presented in the balance sheet, because its amount is so small compared to the total of the balance sheet, that means that the item is immaterial and in that sense might be irrelevant, because being included in the balance sheet or not, it doesn't make big difference for those that are going to analyze the information as a whole. Nevertheless, there is a requirement of the information to be complete, otherwise it might not be faithful. However, the requirement for completeness is subject to materiality issues. Linked also to the relevance, it comes the fact that information must have confirmatory value, predictive, or both. This means that an information is relevant also when it allows to confirm judgments that decision makers or users were making in the past, and with the present information they come to confirm, or also information about economic and other phenomena that exist or have already occurred can also have a predictive value in helping form expectations for the future. This is the predictive value. And of course, these predictive and confirmatory roles are very related. A second characteristic, also very important, is the faithful representation. Basically, this characteristic is related to the reliability of the information. The information that is presented in the financial statements must be true, must be a faithful representation of what it purports to represent. And this implies that for the information to be true, to be faithful, it has to be neutral, complete, free from material error, presented according to the substance of a legal form, and considering prudence. Well, what does all this mean? Be neutral. Neutral means be absent of bias and judgments. The preparer of the financial information cannot select the information one more important than the other one to be included or not to be included. On the other hand, the information has to be complete within the limits of materiality. It has to be complete because if some material item of information it's not presented in the financial statements, so then the information might not be reliable and truth to the reality. And of course should be free from material error. What does this mean? In fact, the statement says free from error as is possible. This does not mean, in fact, complete accuracy in all aspects. Free from material error means that there are no errors or omissions that are individual or collectively material in the description of the phenomenon. To be a faithful representation, the information also has to depict the substance of the transaction, the economic substance, prevailing over the legal form. We already talked about this principle before, and furthermore, it has to be prepared according to prudence. We all know that entities and governments they face uncertainties, and in those situations of uncertainties, risks they face, etc., the judgments have to be made to reflect those risks. And prudence says that the risks has to be reflected in the accounts, in the financial statements. But while reflecting those risks, making those judgments, caution has to be considered, so some prudence have to be considered, and for example, to use the best estimates. In fact, prudence means the inclusion of a degree of caution in the exercise of judgments. And this is needed in making the estimates required under conditions of uncertainty. But prudence has to be considered in order that assets or revenue are not overstated and liabilities or expenses are not understated. Because otherwise, again, the information is not a faithful representation of the phenomena it purports to represent. But there cannot be excessive prudence, because excessive prudence might imply, for example, underestimate the assets, or overestimate the liabilities. And this will lead, for example, to hidden reserves, because organizations or entities might, for example, exaggerate on their obligations, the amount of the obligations, or on the other hand, reduce the value of the assets too much for impairment, due to impairments, for example, and when in fact the assets value is higher than what is stated. So we are not being faithful, the amounts are not being a faithful representation, and that excessive prudence in underestimating the value of assets, for example, can create hidden reserves. Another characteristic is understandability. Of course, for the information to be useful, it has to be understandable by the users. But we know that financial information is complex. Of course, if the information is presented in a simple, plain language, etc., it is and in a systematic way, etc., of course, it is better understood. But this understandability characteristic has one assumption underlying it, is that users have a minimum knowledge about the financial statements that they are reading. This is an assumption that is highly questionable, because this means that only users that in fact know about accounting and financial statements, they understand the language. The common citizens, taxpayers, do they understand? Politicians, do they understand? Think about a new trend of research as well in practice that is coming from the United States and coming to Europe, that concerns popular budgets and popular reporting in public sector, in the public sector setting. Popular means that they are addressed to the people, general people. Another characteristic is timeliness. Timeliness is very important because it's related to the moment where the information is actually produced and disclosed. And sometimes, in order to be very accurate, information takes time to be produced. And when it is disclosed, finally disclosed, it's not useful anymore because it's out of date. So any delays in preparing information might jeopardize the relevance and the usefulness and the opportunity of that information. However, some information, even if it comes from a long time ago, might still be useful. The final two characteristics I would like to highlight relate to comparability and verifiability. Comparability is a characteristic that the information has to have that allows to be compared in space and in time within the same organization or the same government a long time, to identify trends, changes, compared estimated values with actual values, for example. And the other characteristic is comparability in space. For example, within organizations in the same sector, education, health, etc., compare the same information in the same year of different organizations in the same sector. And comparability, it's not the same as consistency or uniformity. Although, for example, consistency is a requirement for comparability, because for information to be comparable, either between organizations or in the same organization a long time, it has to be prepared according to the same principles, the same policies. But that does not mean that the policies or principles have to be the same all the time. That is uniformity. Uniformity cannot compromise comparability. In fact, what is a requirement for comparability is consistency. And consistency does not mean that the policies cannot be changed. In fact, policies can be changed so as the information might become more relevant or more reliable, faithful, etc. But in order to assure comparability, the changes of those policies have to be reported or disclosed in the notes to the financial statements, so that users can understand what has changed and what can be compared. A final characteristic is verifiability, and verifiability is linked to faithful representation, close linked, although it's a different characteristics. But it helps assuring that in fact faithful representation, the information faithfully represents what it purports to represent. An information is verifiable when someone from outside can actually verify. There is some support to check whether the information is true, for example. And that verification can be direct or indirect. For example, it's quite easy to verify the amount of money that one organization has in the bank or in the safe. Several different people can go there, count or check the bank balances and verify that that information in fact is correct compared to what is stated in the balance sheet, for example. So independent observers can be directly and verify. There is also a way of indirectly verify that information by making calculations. For example, if we talk about the inventories in one organization, independent observers can, like auditors, for example, can go there and check, applying the same criteria, measurement criteria, and check whether the inventories that actually exist, valued considering the average cost or the first in, first out, correspond to the amount that is actually presented in the financial statement. Finally, before we finish this part, I want to highlight that the balance between these characteristics, it's not so easy, and there are some constraints that sometimes restrict or limit that these characteristics in fact are reached. For example, there is always, apart from the materiality issue that I already talked about when I addressed the relevance characteristic, one thing that in the balance of these characteristics, one thing that is a constraint is a cost-benefit analysis. It is important that the information has these characteristics, but sometimes it has to be considered that the benefits for the users of the financial information has to be at least equal to the cost of preparing that information with these characteristics. And sometimes, so if the costs exceed the benefits, perhaps it's not worth it to prepare this information. Let me give you an example. For example, in my country, in this new accounting system for the public sector, it was decided that for small size and micro entities to have a simplified regime of financial reporting, because to follow a general regime of complexity with a lot of financial statements was too costly compared to the benefit for the users of financial information of those small entities that were also considered not so material in terms of public expenditure, for example. On the other hand, another constraint to these characteristics is that sometimes it's not easy to balance all of them. Although I said that there is not a hierarchy of importance, sometimes to get relevant information, we can compromise the faithful representation or reliability and vice versa. Because to have more reliable information sometimes takes more time, so the information is not timeless and the relevance is jeopardized. So neither a phenomenon that is faithful represented but irrelevant, nor a phenomenon that is unfaithful represented but relevant is useful information. So normally this balance between relevance and reliability sometimes is not easy. Well, thank you for attending this part A of our lecture, and we are now moving to part B, where we are addressing the elements of the financial statements and the recognition and measurement criteria. Thank you.